Good morning and welcome to this Wednesday, June 28th, 2023 edition of Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as you prepare for the trading day ahead. It's good to see everybody again. I know we had some technical issues last week, or maybe the week before with the video. Hopefully we got that resolved, but it is good to see everyone this morning. I was away for a few days, got recharged. That was a good thing. Had a family reunion away in Washington, D.C. area, which is about, I don't know, maybe 6-7 hours from where I live now down in South Carolina. But it was a great trip. Really enjoyed it. Thanks to all of our members for your patience. I know we kind of, some of the services we provide, we kind of just took a little break, but it's good to kind of get away and recharge for a few days. Coming back, seeing the market, we did drop for a few days, and that was to be expected. I mean, we had such a huge run to the upside, so I think it's always a good thing to kind of pull back. I think the market needed to recharge its batteries as well, and so I think that's what we've done to some degree, although I'm not quite sure it's over yet. Yesterday was a very encouraging day because we did see the market move back up again, clear some, at least clear the downtrend line that we had seen over the past several days where we kept putting in lower highs. We did get that higher high yesterday, and I thought that was a good start anyway to maybe beginning to move back to the upside. But we may be in a period of consolidation, another slight move lower. We didn't quite get down to the 20-day moving average on some of the key areas that I follow, but we did pull back, and that was good. Looking at futures this morning right now, this was delayed a little bit, but I showed Dow futures down 25, S&P 500 futures down 11, NASDAQ futures down 71. So a little bit more selling on the NASDAQ again this morning. Crude oil prices right now down 30 cents, 67.40 a barrel, getting back down close to the recent lows. And the U.S. 10-year Treasury yield 3.75%. And that is down about 2 basis points so far this morning. Let's go ahead and check out what happened yesterday. So let me get this set up for you so you can follow along. Okay, you should have my screen up now. I know a few of you, I keep forgetting to change my cursor. I know some of you have asked for me to make that cursor a little bit bigger so you can follow it as I'm going across the screen. I keep forgetting to do that, but I promise I'll try to get that done before the next show. Dow Jones Industrial Average yesterday was up 212 points. The S&P 500 up 50. NASDAQ 100 up 257 points. That was 1 3/4%. So we had a really nice day on the NASDAQ. Mid caps up 41 points. Small caps up 20 points. Small caps also up 1 3/4%. And I noticed yesterday there was a lot of fluctuation intraday between the performance of the NASDAQ versus the performance of the Russell 2000 or the small cap index. Or actually the small cap 600 index is the $SML, which I show here. But I also like to follow the Russell 2000. So you'll see me point out the IWM a lot. It's just a different small cap index, but it's still one that I like to follow. Both these groups were up 1.75% yesterday. I'm talking about the NASDAQ 100 and the small cap 600, the S&P 600 small cap. But the way they got there was a lot different. Early in the day, it looked like the NASDAQ was moving up pretty good. And small caps actually went negative for a brief period in the morning. And then the small caps took off. The NASDAQ pulled back. And then toward the end of the day or in the afternoon, we saw the NASDAQ play catch up again. And they finished identically up 1.75%. So there's a little bit of rotation throughout the day, but overall, I thought the market did very well. Check out the transports. Transports up another 2.7%. This is a group that I said if we got above about that 14.5, 14.6 level, this was an area that could run to the upside. And we saw that transports really starting to make a move. I'm going to talk a little bit more about transports and what we can expect and what we shouldn't expect from transports as we move forward. Oops, I'm sorry. Getting the trying not to get this computer in the way here. The discretionary Technology and communication services sectors, those were your three leaders yesterday. Remember, those were the three groups that have been leading throughout 2023. So when you get the pullback and those groups don't do so well, it's nice to see them reemerge as leaders again. And that's what we saw yesterday. So at least from that standpoint, it was a good thing. We haven't broken out, though. Look at all three of these charts. Discretionary held up the best over the course of the profit-taking period that we've seen over the last 5 to 7 trading days. And we're close to another breakout on the discretionary, but still got a little bit of work to do there. Technology's pulled back to the 20-day moving average, so that was a good thing. And now it's bouncing off of its 20-day moving average. Communication services, same thing, pulled back to the 20-day, starting to bounce off of that. We haven't seen a close below the 20-day, or we certainly haven't seen many since going back into March on both the XLK and the XLC. So those have been the two leading sectors for the year. A breakdown below the 20, I think, would halt the S&P 500 and the NASDAQ probably a little bit longer. We'd have to see what kind of rotation would come out of that. So far, I think the rotation's been pretty good. Look at these areas that have been moving throughout June. We had the airlines rising from 150 to above 180 just during the month of June. So you can see the XLC has been mostly flat. Technology's up slightly, but when we've seen money rotating, when we've seen money coming out of some of those aggressive areas, it's been rotating into some other areas, other key areas. I do think transports are really important. They don't have to lead the market, but you do want to see them remain in an uptrend, and I believe that's what they're in right now. The truckers, look at this breakout on the truckers. You had multiple tops coming across here right at about 1,500. Broke right through it yesterday, up 4.48% on the truckers. That was 66 points to emphatically close back above that 1,500 level. I love it when the transport stocks are moving. Those are not the areas of the market that I like to trade because they're not generally leaders. And I'll show you what I mean about that in just a few minutes when we pull up some of the transportation charts that I have for you. But you want to see them going up because when they go up, the S&P 500 almost always follows. And so we like to see a strong and strengthening transportation group, and I think that's what we have right now. Recreational services also been on a big run since the beginning of May, rising from the upper 60s to about 90, well, closed at 96 yesterday. So that's been a move of probably about 40% in less than 2 months. That's been a very, very strong area of the market. If you've noticed, a lot of the cruise lines, Royal Caribbean, Carnival, Norwegian, all of those have been having big runs to the upside and helping to push this recreational services group higher. 10-year Treasury yield today, relatively flat. Let me give you a quick update here. Right now, we're at 3.75%. So we're down about 2 basis points. Right now, we closed yesterday at about 3.77%. We gapped down today a little bit. I just see the 10-year Treasury yield going sideways here. Not really showing us anything. I think the intermediate term is to the downside, short term to the upside, but really just kind of trying to hold on to this rising 20-day moving average of the 10-year Treasury yield. Moving on to the S&P 500, let's take a look at what's going on here. Well, when we had that top and that little bit of a reversal back, a week and a half ago, one thing I talked about was the 20-day moving average. The other thing I talked about was we were going through or heading into a historical period where the S&P 500 struggles. The June 18th to about 27th period, not very good. Today is the 28th. So we got a couple of, we're now past that historical weakness period. And perhaps yesterday is getting us started on another run to the upside. We need some more evidence. Could just be sideways consolidating. I would continue to watch that rising 20-day. Do you remember when we were talking about trying to get through the August high? That close was at 43.05. When we went through, we melted up to about 44.50. So that was a really nice move through 43.05. We left no doubt as far as a breakout above the August high. We could have closed at 43.10, 43.12. and then gone right back down. And then you look at it as a technician, you think, okay, that really wasn't a confirmed breakout. Well, what we saw was a confirmed breakout. We went through that 43.05 level and we were straight up for about 5 days to 44.50. That's a big move through a key resistance level. Now, if you notice, we pulled back, and I'm going to hit this inspector button, come over here and look. Where did we pull back to? We got back to 43.28. We didn't get all the way back to that 43.05 level, and that's why I'm still just a little hesitant to say, hey, we've bottomed and we're going back higher. Maybe we're going to consolidate here for a little bit. The rising 20-day moving average is at 43.20. We know that price support area is around 43.05. So if we were to pull back, that's an area that I would watch for. Now, when I initially talked about a pullback, I said 4,300 looked like, a real possibility just because of price support and the 20-day moving average. But if things really picked up to the downside, it wasn't out of the question to see us move back somewhere down around 4,200. We had gap support at 42.21. That was from June 1st. And then we had the 50-day moving average, which right now is 42.10. So that area down in there could come into play if we fail to hold the 20-day. Now, I am personally believing we're going to hold the 20-day. So that's how most of my trades are going to get set up. I'm just thinking that this is going to be an area where bulls are going to step back in. We're going to see some support. But if that fails, then I would maybe be looking at those lower targets I talked about. The NASDAQ 100, also reversal about, 7 trading days ago, all the way back down almost to the 20-day, again, almost to that breakout level. If we use the inspector button there again, the high candle body on the NDX from June 7th was the open at 14,573. And I believe, let me go back a little further here. No, the reaction high. I was thinking this reaction high came in right around that 14.5 area, but it was a little bit lower, 14.3 over here. But anyway, we moved all the way up to 15,285. And if we look all the way back here to these highs, this reaction high back at the beginning of February 2022, this was when the cyclical bear market was getting underway. Notice that we had bounced back up to about 15.2. And then we went back in March and actually went just a little bit higher, 15,265. And then recently we hit that 15,284. So that's a pretty good level. I'll get rid of the inspector button. So when I see something like that, if I just wanted to kind of have a reminder, that's your resistance from back in beginning of February and end of March of 2022 during the cyclical bear market. We went back up twice, could not get through that level, then continued our trip to the downside. Of course, we had the bottom calls I talked about in June, and then again in September. We ended up going a little bit lower, and that gap down in October was a CPI report. That was the September CPI. We gapped down, but then came roaring back. I think there was a ton of accumulation that day as we gapped down and then finished higher. Big hollow candle. Anyway, that low never gave way. And then we started coming back up. But now we came all the way back up to this area around the 15,280, 15,270, 15,280 level. Pulled back. Next move up and the next breakout would be a big one because I don't see anything really until the all-time high on the NDX, which was back in November of 2021. And that was up above 16.5, I think even 16.6. Let's pull back out of here for a second. So that high candle body was 16,645. So if we break above this 15,280, let's get through 15,300. I think the next move is going to take us up to the all-time high. That's what I would be looking for. One other possibility that I'll throw out there, because once we are in an extended move to the upside, you do need to start paying attention to the possibility of negative divergences. And if you notice, anytime that we've gotten up to about that 3 level, on the PPO. We did it right there back in August of 2022. What happened? We sold off. We got there or just shy of there, back in February, early February 2023, and we backed off. And now here we are again, and right now we're backing off. If the market goes back up and we do set a new high, get back up above that 15.3 level, we're probably going to have at least an initial negative divergence, because it's not likely that PPO is just going to go shooting back up with a few days of strength. Normally, after an extended move, it's a little harder to get that PPO going. So then at that point, what I'd be looking for is, if we do get the breakout, watch for a reversing candle. Because if we get a reversing candle, maybe a little bit higher volume, and we have a negative divergence, a lower PPO on that higher high in price, that could be a little bit more of a period of weakness. And so what I'm thinking heading into earnings season is that maybe we'll get that breakout, because historically, this is one time of the year where we do tend to move a lot higher. Anytime heading into earnings season, about the 3 weeks leading up to earnings season, when we tend to see the market build in some of those good earnings. So I would suspect we're going to make another push to the upside. But if we get to the middle part of July and you still see a negative divergence, that would be probably time to let off the gas a little bit on the bullish side. I could see a little bit more selling over the summer. So let's see what happens, how this transpires over the next few weeks, and then we'll go from there. The IWM, this is the one that tracks the Russell 2000. I liked yesterday's action getting back up above the 20-day. I also, if you notice, when we had pulled back in March and we had the reaction highs, we got back up into the upper 170s, but we struggled. Every time we got up in 178, 178.50, something like that, we would pull back again and, challenge the low 170s, maybe even the upper 160s before rallying back up to that level. So we were sideways consolidating, but throughout that period, I kept talking about how money among the small caps was rotating from value to growth. And that's usually a good sign. Normally, Wall Street is not going to start buying into the growth stocks if they believe the market's going lower. Normally, that's a precursor to prices moving up. We talked about that throughout 2022 on the QQQ, how I kept saying technology is being accumulated and it's going to lead to higher prices. And we've seen what's happened there. I think to a lesser extent, it certainly is not nearly as crazy in terms of the rotation in the small caps as we saw in the QQQ, and the way the money, we saw all that manipulation early in the morning, sell off, and then big rallies in the afternoon. It hasn't been like that, but the rotation alone tells me that the IWM wants to go higher. So we made the breakout. We rode that TNA for a while, and we got up and we paused in this area of congestion. I say area of congestion because 185 to 190 has been an area multiple times over the course of the last year where we've either failed to break down, we've held as support, or we've failed to break out. We've held at a key resistance level. And so right now, I think we're kind of stuck between a couple of key areas on the IWM. And this is important if you like to trade the TNA, which is the 3 times leveraged ETF that tracks the IWM. So if you're into the leverage and you're, looking at the TNA, I'm actually in the TNA right now. I like the TNA, anything down in the low 180s, maybe even to 179. And if we get back up to about 188, 189, I would think about taking it back off the table until we get the breakout. So that's kind of what I'm looking for in terms of leverage, is just one more move back up, test this. I think eventually we're going to break out. But what I don't want to do with the TNA is just ride it up and down like a yo-yo. These leveraged ETFs are not meant to be held long-term. That's a whole separate discussion. I could spend a lot of time talking about that, but they do erode over time. And so you might say, well, over 6 months, it only went up two times instead of 3 times. Well, if you're okay with that, fine, but it's supposed to go up 3 times. And so you're taking a lot of risk when you get in, because I can promise you if it goes down, it's going to go down 3 times. So if you're happy over time holding on to it and only getting 2 times, that doesn't make a lot of sense to me as far as managing your risk. But, everyone makes their own decisions. I like to get into these juiced ETFs, leveraged ETFs, when they are making a move or when I am anticipating them making a move, and I can keep my stop tight, because I don't just buy these and hold these for long periods of time. I don't think that's a wise move. All right, let's talk a little bit about the transports. So here at the top of this chart is your transportation, Dow Jones Transportation Average. The other thing I wanted to point out is look at the IWM, Russell 2000. Now, transports, if you look at these charts, when the transports go up, IWM goes up. Transports come down, IWM comes down, and so forth and so on, all the way through this chart. Now, they may not go up and down to the same degree, but generally they tend to follow one another. And if you want to see this proven, now this is going back 10 years, maybe you need more proof, but look at the 10-year correlation between transports and small caps. You can see all of these readings, a lot of readings above positive 0.5. How many readings do you see below minus 0.5? I count 1, 2, 3. Meanwhile, most of the time, it's above 0.5. So why is this important? Well, it's important because we've been talking about the IWM, talking about rotation from value into growth. And now we've got the transports on the verge of breaking this downtrend line. And I've been showing members charts about transports. When the downtrend line for a period of time breaks on the transports and they start moving up, the S&P 500 goes up, and so do small caps. So this is another direct correlation that I like to follow when I'm following small caps, is what's going on with the transports. Because if we can get this breakout, and we're getting close, if we get this, we already had a short-term breakout above 14.5, but I'm talking about this 1.5 year downtrend line. If we see this transport group get up much above about 15.6, 15.7, you start seeing those numbers, 15.8, I think you've got a breakout. And at that point, I think you're going to see the small caps do very well, in addition to the S&P 500. Now I'm going to show you another chart of the transports, because I think this is important as well. Here's that same transport chart, except on here we're going 15 years. Now, we had a lot of move lower with the 2020 pandemic. We saw some pretty significant selling in the fourth quarter of 2018. That was the trade war. That led to a cyclical, very short-term cyclical bear market, and transports didn't do well. 2015 into early 2016, transports didn't do well. 2011 didn't do great, in the summertime. But look from 2009 to where we are today, and just keeping things in perspective. Do you see an uptrend? Do you see prices mostly going higher from the left side of the screen to the right side of the screen? Transports are still in an uptrend. A lot of folks were saying, I don't know, a month or two ago, that we were in trouble because transports weren't following suit. Money rotates. Not everything goes up at the same time. That's why, personally, I don't like following breadth indicators. I think they're lagging. So, yeah, the market was going up earlier this year, and the bears always like to try and find something until it doesn't work anymore, and then they look for something else. That's how you can tell someone's a perma bear. When they continually will say, okay, this is, there's no way the market can go higher because of this. And then that gets resolved. And then market can't go higher because of, this over here. Forget about that over there. Okay, that was a mistake. But what about this? Listen, I can find bearish things in the market every single day of every year. I can find bearish things if I want to look for them. I have what I think are some really good signals that I follow. They've led me when the market looked toppy, and they've led me when the market looked like we were bottoming. And so I stick with them. If you want to use other indicators, fine. I have no problem. but I'm going to have my own way of looking at the market, and I'm going to call it objectively, bullish or bearish. And I'm very bullish. And if we get a breakout in the transports, my bullish meter is going to jump up again. So watch that. But down at the bottom of this chart, what I want to point out is that even when transports are going higher, which is bullish for the market, it doesn't always mean transports are leading the S&P 500 on a relative basis. So here's your absolute basis. Here's your relative basis. Transports topped in 2014 relative to the S&P 500 and have been in a downtrend. Now, you might look at that and say, well, that's bad. Transports are downtrending for the last 8 years. Well, they're not downtrending. They're going higher. They're just not going higher as fast as the S&P 500. And as a result, we're going down. Now, recently, you can see that we have started to turn back up again. So just over the past week or two, or a few weeks, actually, this is a weekly chart. No, this is a daily chart. So this goes back, I mean, maybe it's been this month. I don't know. I can't tell exactly based on this chart, but probably for the last few weeks to a month, we've seen transports begin to outperform. Excuse me. And that's a good thing for the market. Anytime the transports are outperforming and moving higher, that is a good thing. And that right now is the combination that we have. All right, we got a few more minutes. I want to go over the chart of the day, the American Express chart, AXP. This is the one I provided to members. And by the way, let's go back over here. And if you're interested in getting these charts of the day, if you want them emailed to you 3 times a week, you can go over to our homepage at earningsbeats.com, scroll down, and right there in the middle of the page, you can subscribe to our Earnings Beats Digest. Again, delivered, published 3 times a week. All it takes is a name and an email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. If you don't feel like this is helping you in any way, whether it's improving your trading results or maybe just, I could put sentiment charts in here. If you don't think that some of the guidance provided in there for free is not worth it, unsubscribe. You're not going to hurt my feelings. It's a way we give back to the community. So obviously there are a lot of things that we do at Earnings Beats I think have tremendous value. Obviously the people that work for me at Earnings Beats and for me, we all want to be paid. So it's nice to have paying members. But at the same time, we do try to give back. We try to teach people about the stock market, hopefully provide some confidence so that you can invest in the stock market and not worry every single time that the market goes down and read all the headlines about why it's going down, most of which make no sense at all, but they're clickbait. And so, that's the way social media and online, financial information works. You're going to have to deal with a lot of that stuff that you see out there. You can't help avoid it. I know I'm not physically going to turn my TV on and watch CNBC, but I go over to CNBC.com and look at the futures. You can't get away from it. You can't get away from the clickbait headlines. But you don't have to click on it. You don't have to read it. I know I can look at my charts objectively. I don't need anybody else to tell me what is going on in the market. I think I can follow it pretty well myself. And so that's the way I do it. And that's the way I try to come across both with our, with the shows, with the articles I write, with our membership and the daily market report that goes out every day, with this EB Digest. All these things are done to try to help folks be a little bit more confident in what they do and maybe provide some coaching along the way. I think, we've had a lot of members kind of refer to us as their coaches. I'm fine with that. I've learned a lot over the years and it's cost me a lot of money. And if I can pass that along to others and save them, hey, that's awesome. Also, I want to point out we have a bullseye forecast coming up for next Thursday, July the 6th. It's going to start at 7 p.m. I'm just going to bring everyone up to date, what has happened, what's transpired, what it looks like, and what we might expect going into the second half of 2023. So if you are interested, go in again to Earnings Beats, both plural, earningsbeats.com, and click on this. If you register, will automatically set you up for the EB Digest. So you don't have to do both. If you register, we'll get you on the EB Digest. You can come to the event for free. We'll send you room instructions. And then if after the event you don't find that you're getting any value, you can unsubscribe. No problems. No feelings hurt. All right, let's look at this chart of the day again here. So AXP, big move up. We've pulled back. I like the 20-day test. I also like this pullback. See these tops after we had pulled back? This was due to that the financial scare that we had a few months ago with the banks, the small banks, and their run on deposits and so forth. Anyway, AXP was doing really well and then fell apart there. And notice when we came back up, we were trying to get back through this gap resistance area. And I could put a line in here on a level right at 165 that I just think is really important, right at about that area. Maybe even go down here to 160. Or actually, that is 165. Sorry. So right in here, right at about 165. Notice the top from all the way back in August of last year, 165. Notice the breakout and the gap up, and then the pullback to where? 165. Then we had the breakdown through 165. Look at all these failures up here trying to get through 165. And then finally, we gap up at 165 and take off. And what did we just recently do? Went back to 165. I mean, I'm not making this up. It just looks like 165 is a key area of support when we're above that line. And if we go below it, you get out. Now, I actually drew a little gap support area right in here from 162.5 to 165. So maybe you give it a little bit of room. And for those who want to give it even more room, maybe you go down to the 50-day. But if I lost all that, if I lose 165 and then I lose gap support and then I lose the 50-day, I'm getting out. And that's only $7.50 below where we are right now. So it's less than 5%. So you can keep your risk to the downside to a minimum. And then you've got your target probably up closer to 180. I mean, eventually I see this going up. I see the market going up. So I could certainly hold on to it beyond 180. But I think that would be probably the first step on AXP would be to get back to that level. All right, market is open. And I don't want to really hold things up much more. So we're going to go ahead and just take a look at what's going on to open. We got the Dow down 107. So that's down 0.3%. NASDAQ down 0.3%. S&P 0.35. Small caps a little bit more than 0.4. Mid caps 0.4. And even with all the selling, we got the VIX up 9.00 or 0.09. Still down in the 13s, telling us that we're not likely to see much selling. The VIX, even on a down day, barely going higher. That's telling me if you understand the volatility index, which is basically just it's looking ahead at the S&P options, those expiring next 30 days in the money, and looking at the premium or those around the money and looking at the premium that is on those options. And when the premium is low, the VIX is low, meaning that the market is not anticipating much volatility ahead. And so when the market starts selling off and the VIX can barely budge to the upside, that tells me we're not likely to see much selling to the downside. So I would expect that we're going to continue in this move to the upside. I do think the VIX at some point will probably jump. It might be if we get a little bit more selling, like I talked about. The summer months can be a little rough sometimes. Maybe over the summer, we'll see the VIX spike back up into the 15, 16, maybe even 17 area. But I think if we get up there, we're probably getting very, very close to a major buy point in a secular bull market advance. I said back at the beginning, 2022, we were going into a cyclical. When we ended, I said it was over. It was a cyclical. And I believe that was the case. And I think we're now in a secular bull market advance. We're resuming the advance that we've seen off of the 2013 breakout of the S&P 500 above 1570. And we just continue to move higher. I think we'll be at all-time highs by the end of this year, early next year. I've been talking about that, but I'll give more on that and talk a little bit more about what we should expect coming up at that Bullseye forecast next Thursday, 7 p.m. So again, make sure you go over here and you click on this and register now. It is open. The best way to guarantee your seat for the event is to register early. We are limited in terms of capacity. So make sure you get registered. All right, that's it for me. I appreciate everybody tuning in. I'll be back again next Monday for your next Trading Places Live here at Earnings Beats. There will be no show on Tuesday over at Stock Charts next week. It's July 4th, but I will be back on July 6th. I know a lot of people have been writing in, by the way, and asking about the Tuesday and Thursday show and why it's not airing at Stock Charts at 9 a.m. And, please, start it back up again. Well, the problem is it's not in our hands. That's a Stock Charts decision. If you go to Stock Charts and you click on Stock Charts TV, they used to have all these shows lined up. It was a 24/7 streaming channel. Now it's on demand. So they're not running any shows as of any particular time during the day. So that has nothing to do with what we do at Earnings Beats. I'm still sending my recording to Stock Charts, but they're not using the channel anymore. So my show's not coming on their channel at 9 a.m. Instead, you have to wait until it gets edited and it gets published to YouTube. And so it'll show up on YouTube probably by 11 o'clock in the morning. But there's no way for me to get that show out at this point at 9 a.m. So anyway, I just wanted to point that out because I know a number of you were disappointed, but we had no control over that. We're talking about right now doing some things with YouTube, maybe a little bit more, maybe a little less in some areas, a little more in other areas. So stay tuned for that. But trust me, we're trying to make sure that we keep you up to date on the market action and as best we can. All right. That's it for me today. Again, thanks for stopping by. Sign up for the EB Digest, sign up for that event next Thursday, and we'll be chatting again soon. Happy trading, everybody.